Hi, good morning, everyone. Welcome to this week's morning call. Today we have a few stock counter updates, Adobe as well as Centurion, and we also have our macro and sector outlook on Singapore REITs, Singapore banking, and afterwards we have our technical analysis. And last but not least, we'll end off the session with Singapore Weekly. This is a disclaimer that all contents presented are just for educational purposes and not financial advice. Without further ado, let me hand over the time to Ambrish to present on Adobe.
Thank you, Iqbal, and good morning, everyone. So last week we had released a third quarterly update report on Adobe with the title Week Sales Outlook. Next slide, please. Overall, the results were in line with our expectations, with 9 months 2024 revenue and adjusted PATMI coming in at 74 and 75% of our full year forecasts. In terms of performance, the total revenue, it grew by about 11% year over year. And this came in slightly ahead of the company's guidance range, top end of guidance range. And this was mainly because of higher subscription sales for its products, like the digital media segment. It basically accounts for about 75% of the total revenue for Adobe. And this segment's revenue, it grew by about 11% year over year. And this was mainly because it includes the Creative Cloud and Document Cloud, two segments. So Creative Cloud, it accounts for about 80% of the digital media revenue. So the Creative Cloud revenues, they grew by about 10% on a year-over-year basis. And this was mainly because of the continued demand for like its flagship products, like the photo editing and video editing applications, like the Photoshop as well as the Premiere Pro application. And since there is a rise in digital content creation, so this boosted the demand for its subscriptions. And secondly, the Document Cloud, the revenue, it was the fastest growing segment, and it grew by about 18% on a year-over-year basis. And this was mainly because of the strong demand for the PDF solutions and e-signature solutions, as the workflows, they have shifted to digital. And secondly, the second positive is its operating margin. It's expanded by about 200 basis points on a year-over-year basis to 37% in the third quarter. And this was mainly because of the beat on its top line, as well as high operating leverage, like careful sales and marketing expenses and measured hiring. So as an instance, its general and administrative expenses, they grew by about 4% as compared to 11% in the third quarter of 2023. So with a focus on cost cutting initiatives, its margins have been expanding. And in terms of negatives for Adobe, despite the strong beat, it forecasts a weak sales outlook for the fourth quarter of 2024. And it now, at the midpoint, it now expects its top line to grow by about just 9% or so, to about $5.5 billion. And we believe that this is mainly because of reduced enterprise spending due to the measured buying environment, and as well as the macro conditions that have been impacting their decisions. And in terms of its segment, its digital media revenue, it's expected to grow by about 10% on a year-over-year basis. And this would be continued to be driven by the Creative Cloud and Document Cloud. And it would witness a growth in number of users, as well as higher revenue per existing user, mainly because as they shift to a higher priced plan. So this would lead to its continued growth. But the net new digital media annualized recurring revenue for the fourth quarter, the company expects it to drop by about 3% on a year-over-year basis. And this was mainly because the company said that a few of the last deals, they were pulled forward in the third quarter. And also it highlighted that the Cyber Monday for the fourth quarter, it now this year, due to the timing issue, it now falls in the first quarter of 2025. And as a result, its net new digital media annual recurring revenue would be witnessing a decline of about 3% on a year-over-year basis. And with respect to its generative AI tools like Firefly, management said that it's witnessing strong demand trends. Since launch, about 12 billion images have been generated through text-based prompts. But despite the strong demand trends, it's we believe that the revenue growth rates have been declining, and as a result, we believe that the generative AI solutions are not yet boosting its top line growth. And mainly because like they are currently focusing on higher customer engagement instead of like immediate monetization of its generative credits. And we believe that in the near term it would still not be impacting its top line growth rate. And as a result, we maintain our reduced recommendation, and we have an unchanged target price of $480 and Adobe, mainly because like we would like to wait for any the disclosure clarity from company with respect to its AI revenue. And also we believe that Adobe's growth rates, revenue growth rates, it has been dropping, and we need to witness an accelerated revenue growth rate. And also it's like it's facing competition from its peers like a Midjourney and OpenAI's DALL-E, which can perform similar function like a user can generate image from text-based prompts on those platforms as well. And as a result, it can impact Adobe's growth and AI monetization strategy going forward. So we would like to wait for any further disclosures for the company with respect to this. And as a result, we maintain our reduce on Adobe. So that's all for me. Would now like to pass it on to Glenn for Singapore banking.
Thanks, Ambrish. Yeah, so for the banking monthly, we'll start first with the interest rates. Yeah, next slide, please. Yeah. So for the interest rates, yeah, this is the talk of the town currently. So this is just up to August, so it doesn't really reflect the most recent rate cuts. But for August, the Singapore interest rates of the 3-month SORA were already down 3 basis points to 3.6%. And this is the lowest that we have seen it since April 2023. And year on year, it was also down around 9 basis points, and it's 6 basis points lower than the second quarter average. So this is the second time that we have seen this 3-month SORA decline year on year since June 2021. The 3-month SORA has been hovering around the 3.6% rate, 3.6% range since January of this year, so since the start of the year. However, moving forward, especially into next month and the rest of the year, we could see it dip even further as it tracks the US Fed rates. And once the cuts have come in next month, then we will probably see the 3-month SORA decline as well to follow suit. For the HIBOR, it was also down. It fell by 38 basis points month on month to 4.31%, a continuation of the decline of 6 basis points in July. Furthermore, it also dipped 67 basis points year on year, and it was also 34 basis points lower than the second quarter average. So we should also see the HIBOR decline further as well. Now moving on to the next slide. Yeah, for the loans growth, so this is a positive, a good sort of highlight for the Singapore banking sector, which is that the loans growth reached a 21-month high. If you look at the chart here on the left, you can see that the orange line, which is the year-on-year growth, it's currently at 1.9% year-on-year in July. So it's reached, this is a continuation of the 0.5% increase from the previous month. So we are continuously seeing the loans growth improve, even in July, the interest rates were sort of stagnant. It didn't go down, it didn't go up, but yet loans has continued to improve. So we feel that this is mainly due to the businesses as well as consumers starting to get used to the high interest rates. Hence, there was an increase in the loans growth. However, we still do expect a low single-digit growth for 2024, as the loan growth is expected to recover even further from the rate cuts and even higher rate cuts going into the rest of the year, which will spur even more spending by businesses and consumers across segments, where we could see further loans growth. So it could even surpass this low single-digit loans growth expectation that we have. For business loans, it was up 1.7%. And the consumer loans was also up 2.2% year on year. And the consumer loans, it was quite strong. This is the 7th consecutive year-on-year increase recorded since December of 2023. Housing loans, which has been very positive for quite a while, it was also up 1.8% in July. For the total deposits and balances, it grew by 6% year on year. And the current account and savings account, or CASA proportion, dipped slightly to 18.2% of total deposits. So the CASA proportion has been ranging between this 18.1 and 18.3% since January of 2024. Moving forward, we feel that there could be a slight dip in the deposits and balances as people are moving their funds, or excess cash out of the fixed deposits or even their current account and savings accounts into, more of a riskier investments or having more of a risk-on sentiment. Hence, this will be beneficial for the banks because they are now being able to push their fee income and their wealth management products, and this will sort of spur their growth going forward. But we still do expect that the CASA proportion will be maintained at around this 18% range for the rest of the year. Now, moving on to the next slide. For the SGX statistics, this is also another interesting topic because this is one of the reasons why SGX share price has performed quite well for the past month, is that their SDAV, or the Securities Daily Average Volume, it rose 29% year on year to 1,370 million in August, and it reached a new high for 2024, while the DDAV, or the Derivatives Daily Average Volume, also grew 9% year on year and month on month. Notably, this is the 9th consecutive year-on-year increase for the DDAV starting from December 2023. So one of the factors that we look at, sorry, is everyone looking at this the SGX statistics slide? Give a thumbs up in the chat if it is. Okay. Hopefully it should be in this slide. Yeah, so the VIX, which is a market index that measures the implied volatility of the S&P 500 index, averaged 19.3. So can someone confirm that we are looking at the SDAV, DDAV table and I think move back one more slide, sorry. Yeah. It should be a table of the SDAV. Yes, correct, SDAV, yes. So sorry, where was I? Let me just recap. So SDAV rose 29% year on year, and it reached a new high, while the DDAV grew 9% year on year and month on month. So for one of the factors, regarding why all these average values went up is most likely that the VIX, which is the market index that measures the implied volatility of the S&P 500 index, was up to 19.3 in August from 14.4 in the previous month. So this spike in volatility was most likely due to the increase in Japan's interest rates, which impacted carry trades globally. For the top 4 equity index futures turnover, it fell by 15% year on year in August to 10.4 million contracts, mainly due to lower trading volumes of the FTSE China A50 index futures. So as I was saying earlier, one of the reasons why we saw this improvement in SGX's share price was mainly due to this increase in both the SDAV as well as the DDAV, which are the main volume trackers for SGX. Now moving on to the next slide. Yeah, for the Singapore Bank's performance, the 3 local bank share price performance was mixed in August. DBS was the only positive. It only rose by 1%, while OCBC and UOB both dipped by 2%. And this decline was mainly due to the carry trade impact from the increase in Japan's interest rates, which affected the banks alongside most of the equity market. But nonetheless, if we look into September, we actually saw that the banks recovered even stronger. So if you look at year to date, DBS has still performed the best, with the largest increase of 20% compared to OCBC and UOB. So we feel that this is mainly due to their FY24 dividend guidance, as well as the FY25 dividend guidance being the clearest and being the highest. And also they also have provided they don't really have a cap on their dividend payout ratio, whereas the other 2 banks have. Now moving on to the next slide. Yep, so we do maintain overweight and we remain positive on the banks. The net interest margins for the banks will dip slightly going into the rest of the year from the rate cuts, but we still expect the net interest income to remain stable, mainly from the movement of deposits into longer tenures as well as higher interest yielding assets. And while on the other end, a recovery in the loans growth as well as a continued double-digit fee income growth will uplift profits for the banks and maintain their rather high dividend yields that they're having right now. So that's all I have for the banking sector. I'll now hand it over to Darren for the REITs. Thank you.
Yeah, thanks, Glenn. Yeah, so let's run through the REITs monthly. So the title is basically rate cut fueled rally as we've seen with the 50 basis points cut, or rather before that, the market had very high expectations of rate cuts, and we saw the REITs rally over the past 2 months. Yeah, next slide, please. Yeah, so this is the share price performance for S-REITs over the past month. We see all subsectors were up, but year to date, most of these subsectors are still down, and the whole index as a whole is also still down 5% year to date, despite being up 4.2% in August, and in July was up 5.4%. So the weakest performer for this month was ARA US Hospitality Trust. So after they released some weak under expectations results for the first half, the share price fell 23.3% in this month. And the outperformer was Keppel Pacific Oak US REIT. And Manulife US REIT also performed very well. So Keppel Pacific Oak was up 30%, Manulife was up about 20%. Yeah, so based on Fed's 50 basis point interest rate cut to the target range now 4.75 to 5%. So we did some sensitivity analysis. Based on every 100 basis points cut, we expect the DPU for REITs on average to increase by about 5%. Yeah, next slide, please. Yeah, so this is the dividend yield spread. So we've seen the dividend yield spread, it ticked up slightly over month on month from 3.2% to 3.3%. This is despite the share price of the REITs rallying, but it's also mainly due to the Singapore 10-year government savings bond yield falling quite significantly. And since 30th August, it's fallen even further. So 30th August is 2.71, and now I believe it's about 2.4. Yeah, so we expect this 10-year dividend yield spread to continue improving, or rather increasing back towards the average, especially since the 10-year dividend yield spread continues to fall, and with the lower interest rates, and we think DPU will likely start to increase year on year next year. So this 10-year dividend yield spread will expand. So just to explain what this 10-year dividend yield spread means is how much investors are being compensated by investing in the risk asset REITs as compared to the risk-free government bond yield. Or if you can look at it like investing in REITs versus a fixed deposit rate, like how much more yield you are getting. Yeah, so there's just a small table on the right which shows the movement of the 10-year and the 3-month SORA. Yeah, Glenn went through that just now as well. Yeah, next slide, please. Yeah, so after the recent rally in S-REITs, we see the forward dividend yield fall, but it's now towards the 10-year average at about 6%. And despite the rally as well, we see the price to NAV is still low. It's still below 1 time standard deviations from the mean of about 1.03 times. So now it's at 0.93 times price to NAV. So we think there's still room for REITs to rally. Yeah, but we note that because of the really sharp rally in recent months or the past 2 months, there's a lot of volatility in the REIT. So yeah, the REITs are down this week. Yeah, but we believe it's a lot of just volatility because of a lot of big buying and major selling. Yeah, next slide, please. Yeah, so we stick to our subsectors that we favor, which is hospitality and retail. So for hospitality, we see that the hotel occupancy is down 1.3 percentage points year on year, but we believe this will start to improve, especially since the international visitor arrivals is expected to return to pre-COVID levels by 2025. And we also expect the hotel RevPAR to increase because of that, and we expect the average room rates to remain stable. It was down slightly 3.3% year on year though for July. But we believe the strong concert lineup and the many MICE events are coming as well to help to support a strong fourth quarter. Like we've seen the F1 yesterday, yeah, we believe this weekend would have been a very strong RevPAR with almost full hotel occupancy and very high hotel room rates. And a lot of concerts are coming also, like Oliver Rodrigo, Dua Lipa, and D. Lau, J. Cho, all these. Yeah, and visitor arrivals is 17.3% year-on-year growth. It is still slightly lagging behind pre-COVID levels by 11%. Yeah, but one more thing to note is that RevPAR, even though it's down year-on-year, is still 21% above pre-COVID levels. Yeah, and another kicker is from China. So China, since they opened their borders, the visa-free entry to Singaporeans in February, we've seen the year-on-year increase in Chinese travelers increase by about 87%, and it is now 2% above pre-COVID levels already. So we think this will continue. Yep, next slide, please. And with the increase in visitor arrivals, we expect retail sales on tenant sales to improve as well. And the tenant sales is the RSI, rather, the retail sales index, is down in July. So we believe the various government handouts and such will help to boost tenant sales going forward. But the thing that we noted from the retail REITs are that the rental reversions are still very high. Like for downtown malls, we've seen many downtown malls like Ion, Orchard, Paragon, and such having rental reversions of 20%. Suntec Mall also having rental reversions of over 20%. And we think this will continue for at least for the rest of the year. And suburban malls also having very strong rental reversions of high single digit towards the 10%. Next slide, please. So our next slide is our recommendations. Not much changes here, just two changes. One is OUE REIT. So OUE REIT, no change in our rating, but we bump up our target price from 33 cents to 40 cents, mainly because of a lower cost of equity assumption in our DDM model. That is because we have a lower market risk premium, and this is basically supported because we've seen the fact that recently they've managed to secure a refinancing of $180 million. And this green bond is priced at 3.9%. Then a few months before, in June 2024, they priced another issuance at 4.1%. So this 3.9% that they just issued is basically a historical low rate since OUE's IPO. So this just highlights that it's the market appetite is there now, and which is why we also had a lower risk premium, and as a result, our target price has increased to 40 cents. And another change that we did was Capital DC REIT. Actually, for Capital DC REIT, there's no change in target price, no change in forecast, everything. It's just that because of the recent share price rally, our rating has fallen from an accumulate to a reduce. So our target price for Capital DC REIT is 1.93 cents. And at the current share price, Capital DC REIT is only paying a dividend yield of about 4.1%. So we do not think that it's attractive in the current market. So that's all for me. Now I hand over time to Iqbal to talk about Centurion. Thanks.
Thanks, Darren. Now I'll be talking about our initiation on Centurion Corporation. So the title of this initiation is Shortage of Bid Persists because it is related to one of our main investment merits, which I will talk about later. So Centurion is a real estate company which owns, develops, and operates worker and student accommodations. So as you can see on the world map, they have 17 assets across many different countries, a total of 66,000 beds. So in the world map itself, the orange color indicates the worker accommodations, while the blue color indicates the student accommodations. And if I can bring our attention to the bar charts below, as you can see, the blue and light blue color are the worker accommodations, and the red and yellow color are the student accommodations, and they are broken down into bed number and percentage of total revenue. So as you can see, the Singapore worker accommodations make up the biggest proportion of beds and revenue. So they have more than half of all operational beds, and they form 67% of the total revenue. So we initiate with an accumulate recommendation with a target price of 90 cents based on DCF valuations, EV over EBITDA of 8.8 and WACC of 7%. So talking about the investment merits, we have three points. The first one is that the shortage of bids. There is a shortage of bids to meet the strong demand from construction contracts awarded in Singapore. Secondly, is because we think that there will be growth from purpose-built student accommodations segment in the UK. Last but not least, we also think that net profit will be expected to grow from the interest rate cuts. So talking about the first investment merits, which is the shortage of bids. BCA actually estimated that there will be high amounts of construction contracts awarded yearly from 2025 to 2028, which is higher than the pre-pandemic average. And we think that the demand can, and because of this, we think that the demand can grow by 2% year on year to 450,000 beds by December this year. So as you can see on the top chart, the chart on top, the dark blue color bar charts shows the demand and is actually higher than the pre-pandemic period. So there is demand from this sector because the sector of construction, marine, and process sector is because government actually mandated that the workers have to stay in approved worker accommodations and not in HDB flats, for example. As for supply-wise, based on government pipeline, we can expect it to reach 438K beds by December 2024, and this is shown by the red color bars in the chart on top. So as you can see, there will be a shortage of around 12K beds by this year end, and this shortage is represented by the light blue color line in the chart. So this light blue color line shortage is the difference between the dark blue color demand chart as well as the red color supply chart. And we believe that this shortage will trend towards the break-even point, which is the 0 mark, as you can see. But we still expect that there will be shortage. We still expect that this shortage will last until the end of 2025. And this environment of shortage allows Centurion to raise their interest rate by more than 20% year on year in Singapore in fiscal year 2024, because they have already done so in first half 2024 year on year. However, at the same time, this also allows them to maintain a high occupancy rates of 95% because of this environment of shortage. As you can see in the bottom chart, the higher rental rates will mean higher revenues in the Singapore worker accommodation sector. As for our second investment merit, which is we expect growth from the UK student accommodations, because occupancy rates for the UK student accommodations have recovered to pre-pandemic levels at 93%, as you can see from the chart on top, from the red line. This is because universities in UK are conducting in-person classes post-pandemic, and there is also a 24% higher student acceptances in UK universities. So as more students are accepted into the universities, and more students have to attend in-person classes, there will be more demand for this kind of student accommodations. So we expect demand to be strong and occupancy rates to remain above 95% for the next 2 years. As you can see, the occupancy rates is also highly correlated to the revenue earned. So we believe that this will continue to drive top-line growth in the UK student accommodation segment. And last but not least, for our third investment merit, we see that the interest rate cuts would drive net profits growth, because interest expense take up the largest proportion of Centurion's costs and expenses at close to 30%. And more than 60% of Centurion's bank borrowings are subjected to variable interest rates in 2024. So our analysis shows that adjusted net profits can increase by around 3.2% for every 50 basis points cut in interest rates. And this is partly due to a drop of around $2.8 million of interest expenses for every 50 basis point cut. And this can also be seen at the chart at the bottom. We expect to see at least a drop of $2.8 million in interest expense this year because of the rate cuts happening in the US. Now I'll talk about the risks for this company. So MOM actually introduced the Dormitory Transition Scheme, DTS, and the new Dormitory Standards, NDS, which is DTS is to be implemented by 2030, NDS is to be implemented by 2040. So worker accommodation providers in Singapore have to progressively transition into the interim DTS standards by between 2027 and 2030. So as you can see in the top image, this is just one of the example of the standards imposed by MOM, which is the occupancy per room. So this is not the full set of regulations, but I'm just bringing up an example. So the red box shows that there should be 12 residents per room by 2030. And actually, most of Centurion's worker accommodations already meet these DTS standards already. However, An example of the standard that is not met yet is at the bottom image, because there's 8, as you can see, there's 8 double-decker beds inside Centurion's Westlight Mandai property. So some retrofitting is required to fit 12 residents eventually. So we estimate that around 3 to 11% of PB of purpose-built dormitory, which is worker accommodations, will be affected from now till 2030. Centurion has 2 worker accommodations with upcoming pipeline of around 5,460 beds. This represents around 16% of their beds in Singapore. So this upcoming pipeline will serve as swing sites to house the workers when the retrofitting is taking place progressively over the years. So we don't think, even though this is a risk, we don't think that supply will be that affected. Yeah, that's all from me. I'll hand over the time now to Zane to talk about the technical parts.
Thanks, Ivan. I'll move on to the technicals. Next slide, please. So first up, looking at S&P 500's chart, last week we saw a new all-time high closing on Thursday, above the 5,670 resistance. So if this previous resistance is able to hold as support this week, we are likely to see new highs ahead, continuing on from this recent bullish momentum. So for current resistance, it's likely to be at 5,730, 5,800. Okay? For the immediate support, is likely to be at 5,600 to 5,675 area. Next slide, please. So we have a technical buy for Micron at $91.22. Take profit levels at $98 and $109. Stop loss at $85. The last close was $90.90 on Friday. So Micron's chart, it formed a double bottom at the $85 level. This was coupled with a bullish divergence and a fresh bullish crossover in the MACD as well. So with this, the price has been consolidating sideways for recently. You could see the price break above it to retest these 2 prior resistances. Next slide. Next one is a technical buy for Singpost at 45.5 cents. Take profit level at 50 cents. Stop loss at 44 cents. Last close was 48 cents. So for Singpost, price broke out of a range consolidation between 41 cents to 45.5 cents. So with that, you could go on to retest the 50 cents resistance level, which is confirm the projected target level when we take the height of the range projected onto the breakout level at 45.5 cents. Next slide. Next one is the technical buy for OUE at $1.06. Take profit levels at $1.13 and $1.18 respectively, with a stop loss at $1.01. Last close was $1.09 on Friday. So looking at the chart, it also broke out of a range consolidation between $1.01 to $1.05, with increasing momentum. So there's a potential for bullish reversal upwards to retest these 2 prior resistance levels. Next slide. And last but not least is a technical buy stop for Mermaid Maritime at 14 cents. Take profit levels at 15 cents and 16.8 cents respectively. Stop loss is at 13.1 cents. Last close was 14 cents on Friday. So for its chart, it broke above a downwards resistance line. This came after it formed a higher low support level at the 13.3 cents level, which was also a prior support level as well. So with a bullish divergence formed when the price made a lower low recently and increasing momentum on the MACD, price could potentially do a bullish reversal to retest these 2 prior resistances. Next slide, please. So just this is a summary of the trades initiated. Currently, Micron is down slightly about 0.35%. Singpost is up about 5.5%. OUE, for OUE, the trade was not triggered as it did not hit the entry price level. For Mermaid Maritime, it's currently flat. Yeah. So that's all from me now. I'll hand over time to Paul for the Singapore weekly. Thanks.
Yeah, thanks, Zane. So I'll just move on to just more macro for me today. Next slide, thanks. So for Singapore, we got some data points on building materials growth. This in volume terms in Singapore. So for RMC or ready-mix concrete, which is basically wet cement, and this is where the producers here are mainly Hong Leong Asia and also Pan United. The volumes continue to be strong. It's up 13% in July. So I guess we get the first glimpse into the 3rd quarter since they already released their first half results up to June. Year to date is still strong at 12. Steel bar, this is more important for BRC Asia, which is the largest steel bar in Singapore with almost 70% market share. The volume's a bit mixed, it's down 20, but just take it with a pinch of salt because the monthly numbers are very volatile. Last month up 25, then down. But if you take the year to date, it's still growing almost 20%. We also got some strong export numbers for Singapore, up 10, following from the 15%, 16% from last month. But electronic exports did even better. It's up almost 35%. So there's a strong rebound underway for exports, not just Singapore, but I think across. We see that in Taiwan and Korea too. For the US, we got the retail sales. No, since 70% of the US economy is consumer related, so this is a very important barometer. We take out motor vehicle and we take out gas because gas price come down, then the retail sales come down, so we thought it's not reflective. So for that, it's still stable at 3.3. We also started to look more into the inventory levels in the US because as elections approach and as retailers might have concerns of a tariff hike, we do see some restocking. So we see the growth rate in inventory is the fastest in 17 months. So this is possible ahead of the tariff risk, and this positive from for the exporters. We'll show you a chart later. Next slide. Moving on to our tactical views, which we normally send out in our morning note, our weekly tactical view. So of course we had the 50 basis points. We thought it was 25. The narrative that the Fed is giving is that this rate cut is not because the economy is slowing, but because inflation is starting to meet the target. Again, this is all narrative. And another reason they gave is their commitment not to be behind the curve. That's to reassure the market. And they did hint that there was the big downward revision in jobs. If you recall, in last month, there was almost 800,000 decline in job numbers because they had to revise all the numbers downwards. So they did say that they didn't say explicitly, but it kind of spooked them that any new job number that comes out now, they probably have to do a bit of discounting. So from the Fed meeting, so the key thing is, will there be more rate cuts? And I think Powell has probably hinted very strongly there will be more. So firstly, there is this thing called the summary of economic projections. So every quarter, all the Fed members will give a projection of where they think interest rates will be. And actually, Powell actually mentioned that use this as the base case. It's not a firm forecast, but it's a base case that everyone can use. So based on that, the base case is that the Fed is looking at maybe 2 rate cuts in 2024 and another 4 more in 2025. Of course, these things can change quarter to quarter, but at this point in time, this is the expectations. Another reason why we think the Fed will still cut is that the Powell did mention that they are still in restrictive policy. It means that the monetary policy or interest rates is still very high, another way of saying it. And they want to recalibrate it to 3 to 3.5. So right now, you can say Fed funds rate is 4.75 to 5. So what is the importance of neutral rate? Neutral rate means this is the rate where before the Fed actually starts to not to move rates anymore. This is the rate that they will cut and it will likely stabilize. So it could be between 3 to 3.5. I mean, depending how you want to calculate it. So all these rate cuts is going to be positive for REITs. I mean, without stating the obvious, because their interest expense will be, we usually say there'll be the triple benefit for REITs, lower interest rates. Their asset values will go up as cap rates come down, and also they will look more attractive compared to bonds. But the other benefit also is that REITs is also a hedge against any slowdown. So if we do get one bad data point, one bad jobs number, I think the Fed could actually go back down to 50 basis point cut. So, and again, it's going to be supportive for your portfolio, because if the economy really bad, then you're going to get the REITs to rallying. The other thing for us, at least my own view, is that DBS is actually up already 30, by today, probably 32, 33% year to date. You add in another 6% dividend, roughly, you're talking about DBS return of almost 40% this year. So for us, we think, at least for me, is to maybe can switch to UOB, because right now, as interest rates start to come off, I think those that have smaller CASA, because then their cost of funds won't rise, won't drop. I mean, can drop faster because they have smaller CASA, more FD rates. So those who have more FD actually will win this time around, because the interest rate can come down faster. And also UOB also, because they got a smaller Hong Kong exposure, because we're beginning to worry of the Hong Kong commercial property exposure for all the banks. Below is some of the events. So the main event will be on Thursday, where Powell will be making some speech. There's another committee will be making a speech. I'm not sure how much more difference, but then there will be on Friday, the core PCE, which is the so-called inflation that the Federal Reserve want to hit at 2%, but the estimate for August is 2.6. So in terms of presentations, we will have Prime US REIT presenting. It's open to everyone, and also we have our Singapore strategy 5th of October on Saturday. It's open to everyone. I think it's at the SGX. Yeah. Next slide. Okay, so this one is just to show you where interest rates are going to be. So right now it's between the 4.75 and so this is September. So by December, if you look at the numbers in the middle, the market is looking at 70 basis points, but the Fed is looking at 50 basis points cut. That means maybe 2 more rate cuts. Then if you slide it down to December, you're looking at 3.4, which is the Fed is looking at 4 cuts. Then roughly, then the market's looking at almost 5 cuts. But in the next 6 months, you could get almost 3 to 5 more interest rate cuts. So this is based on expectations and at the base case at the current at today's levels. Next slide. This is just to show the retail sales. So so long as the blue line, you notice this is retail sales, doesn't collapse, then you won't get any really severe downturn economy or recession. If you look at 2009 or during the pandemic, 2020, then that's when you get to worry. But right now it's just stable. It's not robust. But the thing to note is that inventory is climbing up the red line. So what this means is that there's a big restocking. So why this is important is that if you're an exporter or a supplier, it's not just the end demand that benefits you, it's the restocking of your customers. So if the US retailers are restocking up, then you get this, it's a two-pronged demand, not just the end demand, but the retailers are rising. So if you just one last point, if you look at 2023, you'll notice the red line collapsing. So that's why exports was very weak last year, because there was a lot of destocking because they were running down the inventories. Then this is just to show the Singapore export is better than expected. It's really climbing up very sharply, the red line and the blue line. Next slide. Okay, I think that's it for me. It's very short, just on the macro. I hand it over to take on the questions. Thank you.
Yeah, thanks, Paul. I'll take it on first. Okay, first one is, why is it time to sell OCBC, or is there still room to increase in price? I think there's also another question asking why DBS rallied so much, right? So it's similar. I would say all the banks rallied quite similarly. So for OCBC particularly, is there still room to increase in price? OCBC, they are also trying to grow, not just in Singapore, right? But they are trying to grow in, I think they did mention like Greater China, but I think they're slowing down on the Greater China expansion a bit because of what's happening there. But they have also taken on, like the Indonesian assets, like they have acquired some Indonesian assets, and also they are trying to take the GE, fully into OCBC, integrate it into fully into OCBC. So it's really whether or not these new acquisitions, or this not really new acquisitions, but like the new acquisitions as well as the GE, if it really can integrate well into their ecosystem, and then how much more can they earn from it. They say the increase in ROEs is not significant, but I think there's a lot of other synergies that we will not be able to know until the deal is complete. Yeah, so I don't know, maybe Zane can do some TA on the banks later. There's also, I think, follow-up to this one about Pan United Corp. I'll just leave it open there for the rest of my team to answer. Okay, it's one about the REITs. Okay, someone asked, there seems to be a disconnect. Recently, there was a report that real estate sales in Singapore is at a multi-year low. So how come loans growth for local banks still positive? Yeah, if you read further into their newspaper report or article, it does say that yes, real estate sales is low, but home prices have actually continued to rise. So if you look at a bank, they don't really, to them a loan is a loan, right? Whether or not it's a new loan or it's an old loan, it's still a loan. So while the sales have been low, but if the prices keep going up, that means their loans growth will also continue to grow. And also to take note that the real estate or housing loans only make up around, I think, less than 30% of the figures I showed earlier, right, for the loans growth. So there's still a lot of other segments to loans growth that you must look at. And I think the one that has been sort of growing quite well would be the loans to businesses. So these are like the SMEs or to even to the manufacturing and the construction segment. So those have flipped. So housing loans have historically, at least from the data that we have, has been pretty positive. Even though loans growth was negative, housing loans was still, growing at a good like 1% or low 1% or 2%. But what is sort of making it turn now, the loans growth, would be the other segments which have flipped from being negative to positive. Hence, that's why we are seeing this low single-digit loans growth. So hence, I hope that answered your question on why loans growth for local banks are still positive. And then again, going ahead, we do believe that when the more rate cuts are coming in, loans growth will grow even further. I think there's a few more. Let me just take it on. So the decrease of carry trade in Japan benefited SGX SDAV. Yeah, so I don't think it's the decrease. It's just that the carry trade in Japan did benefit the SDAV. You can see that, in the figures that show. So what we are hoping is that it probably won't be as strong in this month, in September. But, as you said in the second part of the question is, can we expect the similar as Fed rate cuts continue? Yeah, we hope that when the rate cuts come in, then it will sort of boost the market, and it will also be beneficial for SGX's SDAV. DDAV has still been strong, so that's no worry. Few more. Hi Glenn, which SG bank will you prefer and why DBS rallied so much yesterday? So I answered the second part of the question. I don't think it's just DBS. Also, let me answer more on this second part of the question first. So DBS and other banks rallied, also went up, right? Not just DBS. But I will say why the banks have rallied, even though the rate cuts is quite counterintuitive, right? If you think that, rate cuts, that means the banks will be hit because their net interest income, net interest margins will decline. But I think for Singapore banks, it's quite unique because in the sense where their net interest margins are quite protected, at least for, we're looking at the next maybe 1 or 2 years kind of scenario, because they have shifted a lot of the excess funds, a lot of excess deposits into this, locked it into this like longer tenure, high interest yielding earning assets. They could have put it into let's say into loans, but that's it's not certain whether or not they can get these loans, right? So they say, okay, we'll take a bit of a lower yield, but at least we'll know in the future for next 1 or 2 years, I think even up to 3 years, how our net interest margin is going to fare. And secondly, loans growth and net interest income it's just one part of the bank, right? There are other parts which the banks have been growing, and they are, I think, concentrating more on now, and they're trying to diversify out of it, with the impending rate cuts, which is the fee income. So the banks have all pushed very hard for fee income, and we have seen that double-digit growth for all 3 banks. Yep, so that's probably the reason why the banks they're also stable, then their dividend yield is also healthy above 5-ish%. So which Singapore bank would you prefer? I think as Paul mentioned earlier, we do shifting the focus towards UOB, mainly due to that Hong Kong exposure, which the other 2 banks have quite a large Hong Kong exposure compared to UOB at least. So that's the reason why we also prefer UOB. And UOB has been more clear on how they're going to expand into their fee income, right? They held their corporate day where they mentioned how are they going to go out into the rest of ASEAN. So now they're not just concentrating on the usual, loans growth, selling loans, taking deposits, selling loans. So now they're going to really focus on building their ecosystem, which is their app, as well as focusing on the selling of investment products, wealth management products to customers, not just in Singapore, but also in the rest of ASEAN. And I think their Citibank acquisitions have accelerated their progress in these ASEAN countries faster by about 3 to 4 years, if I'm not wrong. Yes. So that's the answer for both of the questions. I think I have a few more. I know I saw one regarding the Hong Kong exposure for which local banks have high Hong Kong commercial exposure. So they don't provide the details like, you know, Hong Kong and then commercial exposure. They did it like I think 1 year ago, but that's not that the information is not really up to date now. So what we do have is that for FY23, DBS and OCBC have the two highest, whereas UOB has the lowest. If you look at profit before tax, PBT, OCBC is highest at 21%, DBS is at 19%, whereas UOB is only 6%. Right, you can see this coming into play even more going into the future because UOB is going to focus heavily on the ASEAN 4, as they call it, which is Singapore, Thailand, Vietnam, and Malaysia. So, you know, Vietnam, Indonesia, Thailand, and Malaysia, right? So these are the ASEAN 4. So they have bought the asset there. They're going to focus more heavily on that. If you look at loans, OCBC is the highest by far at 24%, whereas DBS is at 14% and UOB at 15%. As for deposits wise, again, OCBC is also the highest at 11%, followed closely by DBS around 10 plus, and then UOB is only at 6%. So you can see clearly from this that the Greater China exposure, UOB is really the smallest. And then DBS and OCBC are quite close to each other, quite similar. I think I answered this one about the DBS one. Okay, one last one. The September dot plot showed more cuts expected here as compared to June. Is this more aggressive than expected? How will it impact Singapore and US banks? Yeah, so I think I did talk briefly about how it will impact the Singapore banks. I think let me just say a bit more. So Singapore banks, we feel that their net interest margins, net interest income will be quite protected. And well, it will take a slight hit, but we feel that the loans growth recovery story will be quite good for the Singapore bank. So this should sort of balance out the net interest margins decline, and we could see net interest income being rather flat. As for the US banks, I think it's a quite different story. The cost of funds have been hitting them very hard, which is why we see their net interest margins declining drastically over the last few quarters. So moving ahead, while I think their net interest income will still, you know, take a slight hit from the decline in the rates, but the cost of funds easing will be a sort of a huge relief for the US banks. And again, you know, I think for just banks in general, they're also focusing now looking at the fee income segment to grow revenue instead of just the usual net interest margins, net interest income kind of scenario, which they had for the last, I think, 2 years plus. I hope that's all. I think I've taken all the questions that are for me. I'll hand it over to the rest of my colleagues. Thank you.
Yeah, thanks, Glenn. Let me take over. Yeah, recently the share price of property stocks such as WeHe, Tuan Sing, Hornbook have been rising. Is it just due to interest rate drop? Any views on them? Yeah, so for this rather small cap property stocks we don't cover, but really we think is purely due to this interest rate drop, because interest rate drops really benefits property companies in 2 ways. So because one of it is a lot of these property companies, they are highly leveraged or highly geared because they borrow money to buy land and for construction costs. So they borrow quite a lot of money, and if the interest rates drop, basically the interest that they are paying on these loans will drop as well if they are on floating rate. So that's one, and it will also help on the perspective of the buyer's side. So when mortgage rates come down along with interest rates, the demand for property might start to increase as well. So you might see higher sales through rates for their developments. Yeah, so the interest rate drop will really benefit these property stocks. Why is the SG market not reacting well to the 50 basis points Fed cut? The REITs seem to be going down, whereas the 3 banks are getting stronger. I thought S-REIT should be cheering, but it turns to be the opposite. Thanks. Yeah, so for the banks, I believe Glenn commented a bit about it earlier, and for more of the technical movements, I'll leave it to Zane to comment. But basically, my view is that over the past 2 months, the expectations of the rate cuts were already quite high. So as a result, the REITs already rallied by almost by like I mentioned, about 5% in July and 4% in August. So cumulatively, it's about 8%. And if you count the start of September, it's up even more. Total over the past 2.5 months is about up 10%. Yeah, so there's bound to be some volatility, yes. even though if the rates are cut, it can't be a straight line that the REITs just keep the share price just keep going up. Yeah, there's bound to be some volatility up and down. So in the near term volatility, I'll leave Zane to do the technical charts, but longer term we are still overweight because we believe with the rate cuts, DPU will start to improve starting 2025. Yep. Yeah, I hope that answers that question. How do we decide whether CICT preferential offering of $2.007 is worth to take up if the current market price is less than or equal to the theoretical X rights price or the TERP after the placement, preferential offering and the advanced distribution estimated to be 2.08. Is it still worthwhile to take out the PO? Yeah, so actually I did the calculations. I believe the theoretical X rights price or the TERP before the advanced distribution is about $2.12. So I used the VWAP of the preceding trading day. So if I calculate or factor in the advanced distribution about 2 cents, the target or the TERP I get is about $2.10. So right now the share price is also around $2.10. So for the preferential offering, if you don't take up this PO at $2.00, basically you will be diluted as when all these rights issue and the private placement shares start to trade, it's likely that the share price will come down accordingly. Yeah, so if you don't take up, you'll be diluted as since the TERP and the current market price is still the same, or rather it's $2.10, so it's equal at this current moment. So yeah, we think it is worthwhile to take up the PO. Manulife US REIT TA and FA. Yeah, so TA I'll leave it to Zane, but for FA, Manulife US REIT basically they've halted dividends as we know. Similar with Core, Prime they are paying out 10% of their distributable income, but for Manulife they have different issues from the other two REITs as they have already breached the bank governance and the MAS gearing limits. So the gearing off the top of my head, if I remember correctly, is at 56%. So now they have to reduce the leverage, and and to do so, they are planning to divest some assets, and they've classified these assets in the tranche 1 assets, which are the weaker properties where they believe it's not worthwhile for them to invest in any capex to make the properties better, and they'll just rather sell it. But of course, if it's preferable, they do not want to sell it at such a low price. So that is the issue for them now. They're trying to divest these assets. But from what I see so far and from the first half results, things aren't looking too good at that point in time. But perhaps with interest rate, with a 50 basis point reduction in interest rates as we've seen over the past week, the transactions market would start to improve and maybe the buyer sentiment will start to come back. As currently, or rather previously, only pure equity buyers, like those who have full cash, like private equity or high net worth individuals, they will buy the properties. But now with lower interest rates, perhaps those leveraged buyers may start to come back as well. So we'll wait and see the third quarter if there are any good updates. And yeah, it's likely we'll have them for a corporate insights webinar as well. So please stay tuned for that. Yeah, I'll leave the TA portion to Zane. Thanks. Which REITs to buy after the rate cut? Yeah, so sorry if I could trouble you to flip back to the page where our coverage list. Yeah, thanks. Yeah, so those are some of our recommendations. Those buy and accumulate calls. Yeah, yeah, except for occupancy REIT, because at this price we think the share price has run its due course. Yeah, especially since it's trading at 4.1% yield. Yeah, when we really see a recovery in hospitality REITs. Yeah, so hospitality REITs, we believe the operating performance will still be strong, as well, especially like those REITs like Ascott with a strong geographical presence, as now a lot of major concerts are doing their world tour as well. So all this will help to benefit the properties in all these assets. Yeah, and we believe there is still room for RevPAR growth from higher occupancy, but we believe the RevPAR growth would have moderated to in the single digits as compared to in 2023, where the growth was exceptionally high, like high double digits. Yeah, so we think yeah, hospitality is still okay. Yeah, then SC rates are all falling since rate cut. What's happening? Yeah, I believe I talked about it a little bit about it earlier. Is the fact that the REITs just rarely before, or rather on expectations of the rate cuts, and when rate cuts actually came, I think there's a bit of softening. I think it's just some near-term volatility, but overall we believe there's still room for growth for S REITs. Okay, I think I'll hand over to the rest of my colleagues for now first. Thanks.
Thanks, Darren. I'll take the questions on Centurion. So there are a few related questions. So one question is, what's Centurion market share of worker dorms in Singapore? Second question is, who are Centurion's competitors? So, okay, so in Singapore itself, Centurion has a few competitors. So the top competitors of Centurions are all private companies. So for example, Sungai Tengah Lodge, they have 25,000 beds. For context, Centurion owns around 36,000 beds in Singapore. And then the next competitor is MES Group with 23,000 beds. Avery Strategic Investments, 21.5 thousand beds. Forbes Enterprise, 21,000 beds. And TS Group, 20.8K beds. So these are the main competitors in Singapore. So as for the market share itself, total supply in Singapore is close to 400K as presented just now. But 160K of that supply is non-purpose built worker accommodations. That means it may consist of factory converted dormitories, on-site dormitories. That means the construction employers themselves, they convert their own buildings into worker accommodations. So the actual market share for purpose built worker accommodations is around 245,000 beds, and Centurion owns around 36,000, so that is about 14.1% market share of the beds. I mean 14% market share in Singapore. So as for the question, who are Centurion's competitors? Singapore competitors are mentioned just now. So as for Malaysia, the competitors in Malaysia's business, they are very fragmented. So the biggest competitor is RP Dormitory with 23,000 beds. And second biggest is LME Management with 25,000 beds. The rest is below 10,000 beds. And these two biggest companies are also private companies. So why they are fragmented is also because there's also a lot of employers who own construction employers who own and operate their own dormitories for their own workers. As for UK and Australia's student accommodations, Centurion is considered a small player in UK and Australia. For example, UK, the biggest player is Unite. So Unite has around 70,000 beds of student accommodations in UK. For context, Centurion has about 2,000 beds. As for Australia, the biggest competitor is Scape. It has also around 25,000 beds. That's the biggest student accommodation player in Australia. So in UK and Australia, Centurion will face some competition, but because as we can see, the results actually show that there is a lot of room for Centurion to take in all this strong demand from students, because there is actually a big gap between the entire demand from student as well as supply of student accoms, because there is really very little supply of student accoms compared to the overall demand. That's why Centurion is able to take in Centurion. There is still room for growth for Centurion, even though it is a small player within UK and Australia itself. Yeah. So this answers, hopefully it answers your question on competitors. The next question I have is, what is your view on REIT, who also has a worker accommodations business? So we don't actually cover REIT. Last I checked, it was a public company which also operates worker accommodations, but it is considered quite small. It has about 11,000 beds, if I'm not wrong. So REIT is not considered a very key competitor to Centurion, because as I have listed down just now, the top top competitors of Centurion, REIT is not among that list of 20,000, more than 20,000 beds. So we still feel that REIT is a small player compared to Centurion. As for my view on REIT, we don't actually cover, but as for the industry's point of view itself, as explained earlier, because there will be strong demand from the very strong construction contracts coming in as estimated by BCA. So because of this strong demand and the lack of supply within Singapore itself, I think this kind of industry dynamics will also benefit a player such as REIT, who is operating the worker accommodations. Yeah. So that's all from me. Hand over to my other colleagues.
Helena? Yep. Let me take some questions. Oh, sorry for that. Okay, so sorry for the delay. What's your view on Pan United Corp? So for Pan United Corp, we still like it. I think across the board for the whole construction sector, I think you probably have another 2-year runway. I think 2025 will be an even better year, because as mentioned by Yigban, there's the Terminal 5. There's also the 2 integrated resorts that's going to start spending and issuing. So each one about 7-8 billion. So another 16 billion of contracts. Of course, not all in 1 year. So the runway for construction awards for the next 2 years, the visibility is there and it should still be strong. Yeah. And we start to see, at least this year, the volumes also up, like we mentioned earlier. Any impact on the Hezbollah pager exposure on the market? I'm not sure anyone still uses pagers, but of course, any worsening of the situation in Lebanon, which is starting to happen, I think that is the worry. I think the big worry is that if they start to hit all installations, all facilities, I think that's where you actually get the impact on the oil market. But otherwise, if it's a conflict, I think the market may, again, this is my own view, the market is probably used to this style of conflict, but it's just that once it starts hitting all installations, especially any Saudi Arabia kind of oil facilities, like it happened before, then in 2019, that's where I think the oil price would start to react even more drastically. What's your base case? Your base case, how many cuts for this year? I will just follow the Fed. I mean, since the Fed said that's the base case, so it's probably going to be 2 more cuts, another 25 and 25, until you see some major changes in employment figures. So even the unemployment claims that's coming out on Thursday, that's probably going to impact the market if there's any huge swings. So I think the labor market will be where everyone is focusing on to determine whether the Fed is going to cut 25 or 50. as inflation is trending downwards. Your comment on Jaffa, sorry, I need to get back to you. Let me go and study. I didn't see this earlier questions. Yeah. I mean, in general, if the share price is above, then I think for the Jaffa offer. So the question is, the Jaffa offer given is one-off equal access at 35.5. Should one accept or reject? I think if it's above the current price, then one should just accept it. I think, yeah, because once the offer is over, I think maybe the share price might actually come down again. The next one, I'll move on to will lower interest rates benefit Thai Bev? Yeah, it will benefit Thai Bev because Thai Bev net debt is about 5 billion Sing dollars. But the main thing right now is that everyone's watching the new prime minister as they implement, I guess, lack of a better word, taxonomics. So I think they have a 13 billion of stimulus plan. I think that the first batch could be 4 or 5 billion, if I'm not mistaken. Yeah. So everyone is watching that, whether they can implement it. And I think that should be a boost for the Thai economy, including for Thai Bank. Because I think under this they won't do the digital wallet because I think it's not feasible. But they will do this and they have to spend the money on consumer staples and order within 6 months. So that's a positive, including the lower interest rates. Hypo, do you see new contracts coming for all tech? Yeah, we do, and as our initiative reported, we are looking for any contracts, hopefully, that they can get for their sustainable aviation fuel. So that's a totally new blue sky for them. They've been doing many palm oil refineries, fractionation in Indonesia and Malaysia, but right now the opportunity is outside Indonesia and Malaysia for palm oil refractionation as palm oil facilities get built more outside of these two countries, and the big one will be sustainable aviation oil because it's a totally blue sky. And they also mentioned they are trying to build more recurrent income. So these are the two main catalysts, not just more jobs, but also building recurrent income. Because as any project, the issue with any project company is that how many times PE do you want to give? Because it's very order book based. But of course, when there's a big uptrend, then that's fine. But once when the trend, the capex cycle will eventually end. But of course, if you're doing sustainable aviation, or you're talking like a more 10-year runway kind of situation. But that's what we are hoping and looking forward to. So it will be more SAF contracts and then more overseas contracts. What were the key highlights from 17 Live Corporate Insights? Yeah, actually, Mel wanted to do, but I think she's on MC, so I think we will leave it to next week where she'll present some of the key highlights of that meeting. So apologies, I think she's on MC today. Is there any investment merit to buy Comfort at the current price for 1 year holding period? So for us, Comfort, we think the yield will still be about 4-5%, and we definitely think they're going to pay higher dividends for this year. I mean, they did it. I think they raised dividends, I think 20 or 30% in the first half. So dividends will grow. But we still think there's growth drivers. There was another question on any highlights from Comfort's corporate webinar last week. Yeah, I think the main focus that they talked about was the UK bus business. So for those who do not know, so they do run UK bus in London. They normally take the north and the south on the east quadrant, I think. But I need to split into 4 quadrants. So they were just highlighting in 2019, the competition came in from the French operators. So they were bidding at single-digit margins. And when you do this bus operating, the assumption you make if you want to pay so high is there's no disruption, because any route disruption you have to meet, because there's a scheduled time, and as an operator, so long as you meet the scheduled time or even ahead it, you'll get incentives. So the competition was so severe, they're assuming all the schedules, the bus routes, everything will run smoothly and they'll get the incentive, and that's what he mean by low single digit. But all this competition have exited, and they hinted that their margins are much, much higher right now. So that will be the big growth driver for them. And you haven't really seen it yet because it takes, because every route, the contract period can be 3 to 5 years. So you need the new routes to expire. And even if it expire, you need at least another year before it starts to implement. So you only I guess maybe 20% of the contracts you're only starting to see in the UK. So I think he and the other thing that was mentioned in the event was they acquired this company called CMAC, which actually helps during holiday season. They will if there's any disruption, somebody has to handle it, and this is the company that does it globally. And the advantage is that they have a direct linkage with all the hotels, because when there's a disruption, you need to secure the rooms and all that. So not many operators can do that. So that was one of the attractions for CMAC. So they just said that during holiday season, so third quarter should be a very strong. This coming quarter should see strong numbers for Comfort, because you got this new acquisition, and which will be strong seasonally. Hyper, what's your view on Hyphen Ceradan Advanced Band Palm announced last week? Okay, so they announced another product extension. So Ceradan is famous for eczema, so this one's for the hand eczema. For me, I don't think one product alone can move the needle for them, but it's more the trajectory. So the last 2 to 3 years, I think, especially post-pandemic, you notice the company has gone very aggressive in terms of more product extensions. So they will extend products like gummies. I know it sounds gummies, but gummies is I guess a new way of adults consuming vitamins or whatever. So they make product extensions on that. They also, so it's two-pronged for the proprietary brands. They are making more product extensions. They're moving into more countries, including the Middle East. And something like this is another product extension. So they are building a brand, and to build a brand is not overnight. So this is going to be a multi-year journey, like we highlighted before. But directionally, you see them building that brand. So they are more aggressive. There are more touch points. I guess the Ocean Health is turned to gummies, and it's moving to 7-Eleven, moving to more distribution points in Singapore. So directionally, there's that. And the other part of the business, which is specialty pharma, then selling prescription drugs to doctors, which doctors are the most hardest people to sell to. So they're launching more products. They don't have a number, but I think it's probably doubled from the previous type of pipeline that they had. So they're also pushing that. And the third one in the background, they're also building e-commerce. You can take it like a Lazada equivalent, but for doctors and pharmaceutical. So they're really building a lot of value, but all this is not going to move the earnings did well because of year-on-year, but you're looking at maybe a 15%, high teens earnings company. But more important is they're building something resilient and recurrent, because you're building a brand, right? So that's the highest value that you're building. But all this costs money, and you won't see the benefits immediate. But this one is you're riding on one of the few rare companies in listed, at least they're building a brand name, in consumer brand name in pharma and nutraceuticals, and also specialty pharma products in the region. Specialty pharma is not brand. That one they just sell doctors. It's almost like a distribution type business, but very high margins, like you're saying, to doctors. The next question: why the market is bullish for more cuts than September projections? So the market expectations moves. I mean, it's very volatile. Sometimes it's more aggressive. Sometimes it's more. So you just take it as a guide. You can't take it as a forecast. But the one unique thing from the recent FOMC meeting was that Powell mentioned, I think twice, that use the SEP or the projections by the Fed members as a base case. So of course, there's a lot of debate whether it's using the dot plots is it useful or not. But again, this is the Federal Reserve members, so you can just use this as a base case. It's not concrete. You still need to look at data, but I guess it's a very good guide that they are still looking to cut. At least you will know the intentions that they want to cut at least. Will Raffles Medical benefit from rate cuts? Raffles Medical won't, because they are a net cash company. So just to give our narrative on Raffles Medical, you will notice that in the most recent quarter, the one that has done very well is IHH. Because IHH, which is your Parkway and Gleneagles, they do the very high-end specialist care, and they are doing very well. But for Raffles, I think they're squeezed a little bit, my own view, because they are squeezed by public hospitals. I think insurance companies are pushing more patients into the public hospitals. Then at the very high end, you are squeezed because it's very hard to compete with IHH, because all I won't call it the best, but the highest end specialist care treatment, oncology, cancer treatment is all done out of IHH and Gleneagles. Not all, I'm just saying that they have a large share, although it's very hard to quantify it, but you just look at the most recent results, you can get a sense that they're definitely doing much better. There are a lot of private hospitals. So what are the main challenges that Thomson Medical is facing? What is positive you can look forward to? Okay, so for Thomson Medical, they are doing a bit more of organic thing. lack of better word, again, they are cleaning up the constitution. So Thomson Medical, if you go right now, is very O&G, that means for deliveries, for pediatrics. So now they're trying to expand it. So I think they do admit, the numbers show for themselves. Their bed occupancy is only 50+%, whereas your competitors are 60+%. So you're losing a lot of margin there. So what they're trying to do, at least for Singapore, is they're trying to add more specialists. So that's number one, add more specialists. But the problem is sometimes these specialists are visiting specialists. So visiting means they are not based there permanently. So then the next evolution is try to keep these specialists to be permanent. So once permanent, you get better traffic. Because visiting, right, they will come only once a week or twice a week. But if you're permanent, so it's a journey. Their average bill per patient, I think we presented before 2 weeks ago, was I think only 5,000 the inpatient. Where if you're talking to Glen Eagles, you're talking about 20,000 per inpatient. Okay, you can also argue maybe it's a bit over, very expensive, but you will notice the difference. So the upside for Thomson is to raise the inpatient. To do that, you need to get more specialists. Yeah. For Malaysia, not so bad. I think Malaysia is doing well. They have a lot more specialists. Just that in the near term, there was a bit of this insurance thing. And the big driver will be the third one will be for Thomson to get the Johor land, to sell or develop the Johor land. So that's the big upside for them. But I think that can only happen once the details of the SEZ, the Malaysia Johor SEZ, to finalize end of this year. Okay, construction sector, Tiong Woon, yeah, we will try to get them to do a presentation. So, like I said, I think all the construction companies will benefit. And Tiong Woon will benefit if you're especially if you're as we go into these big infrastructure projects, you need larger and larger, heavier and heavier crane operators. So that will be the specialty. But again, I think the whole sector will just benefit. Just that we will try again our best to try and get them on for. Paul, any new developments for SingPost? I don't think there's anything new. There's some news that they want to sell something in Australia. I think they've highlighted that before. But I think the one they want to sell is their freight forwarding, not the core 4PL business that they just bought, but it's more the freight forwarding business that they want to sell. I think they made it quite evident that that one's very volatile and may not fit into the strategy. Okay, I think the rest, I think I'll leave it for Helena and maybe Darren to take on some of them. Yeah.
Yeah.
Okay,
You go ahead.
I'll take some of the questions. Sorry for the delay earlier. Okay, some Apple question. Hi, Helena. iPhone 16.
Helena, I think your camera, sorry to interrupt you.
Oh, sorry. Let me try one more time. Is it good? Okay. Hi, Helena. iPhone 16 resale prices collapsed in the first few hours of trading in China. Do you expect iPhone 16 demand to be worse than 15? Yes, Pinduoduo slashed the price for pretty much all the models for around 10%, which is quite a lot when it was just launched. So, I mean, Apple has been facing headache in China for quite some time now, and doesn't really help when Huawei just came out with a triple phone, so that kind of steals all the spotlight. They released a new product on the same day, so Huawei came out with all the revolutionary changes, while iPhone hardware is pretty much the very Monday update. So it kind of sent a message that Huawei now is the pioneer. I mean, of course, the Huawei's triple phone, they're not really targeting to the mass public, but it kind of sends out the message where, you know, like people, even they cannot afford Huawei's high-end phone, they now decided they're going to sit on the fence for and observe how the market rolls out before they decide whether they want to buy the phone. So definitely China market is a lot of struggle there. I mean, but if you look at the entire world, there has been concern on the demand. There have been people in all different countries complaining that, oh, you know, previously when iPhone just rolled out, it's sold out everywhere, but now there's always abundant stock ready for you to pick up. But that's not really a good standard to determine the demand, because you don't really know the supply. Because Apple itself, they're actually planning almost 10% increase in their iPhone 16 devices. So definitely they prepare a lot more stocks there. So just because there's abundant stock left doesn't mean that demand is not there. So we can't really tell. What we can see is T-Mobile, their CEO recently did an interview They kind of reviewed that iPhone 16 sales is actually doing much better than last year's model in 15. He hasn't provided with the numbers, but definitely it's going to be doing better than 16. So I guess overall, we still expect iPhone 16 demand to be better than 15. I mean, Apple is betting everything on its software instead of Huawei that's focusing more on the hardware. And when they just announced the Apple Intelligence in June, the market response is actually very positive. But because of the slow rollout of the whole AI scene, the interest kind of died down. But that does not mean that it's not going to be a powerful move. So I'm still quite optimistic about Apple and their Apple Intelligence rollout. It's just going to start later than expected. But overall, to answer your question, 16 demand is still better than 15. I see another question about the EU warning for Apple to open up their operation system. I mean, Europe accounts for around 26% of Apple's revenue. So if EU does require them to do to open up their operating system, high chance they will confirm with whatever requirement that EU asks them, but it's unlikely to materialize in the near future because it's a quite substantial change, and Apple is definitely going to put up a big fight and ensure that its interest is protected. It's similar as in the beginning where they start including the third-party app stores on iOS. They're charging additional core technology fee and other processing fees just to make sure that their interest is protected. So similar for this, I think likely they're going to apply a similar fee framework like licensing fee or something if EU definitely demands them to open it up. So yeah, unlikely to cause big changes on them. I saw one on Amazon Intel. Any impact on Amazon when Intel wants to make AI chip for them? I mean, AWS has been using Intel processors over the years, but recently they've been shifting more towards their in-house design. But just to know, Microsoft just recently, they've also announced that they're going to be using Intel for some of their in-house chips. So I guess for Amazon, the impact is not really there. The more impact is actually on Intel because it kind of build confidence that Intel can still compete with the likes of foundry leaders like Taiwan Semiconductor. So it's more impact on Intel, I would say. And I see some questions on C Limited. So the Biden administration took aim on Shein and Temu. So whether there's any impact on C, well, definitely there will be impact because the price of Shein and Temu is now could raise as much as 20% if they mend the loophole there. So I mean, previously their competitive strength is their really low price. I mean, now the price will still be low, but definitely the edge is not there anymore because in order to trade for low price, Shein and Temu, usually the delivery time is very long and the quality is not very good. So I guess if the price is not that competitive, less people will be willing to wait so long and for the not so good quality product. But impact on C, I would say it's not as much because even currently, C does not really see them as very direct threat. Because Shopee being an Asian country e-commerce, the price on Shopee itself is already pretty low. If you compare with Shein and Temu, it's pretty much the same. But that also you have to weigh in over the years. Shopee has been developing its logistics, local logistics. So its delivery speed is way faster than Shein and Temu itself. So even right now, it does not really pose big threat. Shopee right now, they're still actively pushing for market growth and they grew 33% year on year. In the last quarter, they're still aggressively pushing and they're comfortable to the point where they start boosting its take rate in order to increase their monetization. So the competition is not really something they're worried about. Do I miss out anything? Oh, hi, Helena. Any positive for C applying for a virtual bank license in Thailand? C Money has been growing quite well. Last quarter, I think it grew like 20% year on year. Consumer and SME credit business is still their key drivers for both revenue and profit growth. There are a number of consumer and SME loan users surged by 60% year on year in the last quarter. I think Thailand will be their fourth country, so they're actively expanding. Everything was quite healthy. Yeah, guess that's all. Hope that answers your question. I'll pass my time to to Darren.
Yeah, thanks, Helena. Yeah, there's a question about Ascot. Where is it? Give me a second, let me find it. Hi Darren, what's the impact of Ascot Limited's new signings? Yeah, so Ascot Limited, they signed about 28 new signings and open and about 3,400 new units. So that will so yeah, so they decided that so that will help to boost both their fee income because from the management of these new operational units as well as the balance sheet because they are holding these assets on their balance sheet. So this is basically have to boost their income from REIB as well, from the hospitality side, as well as the fee income that they collect from operating these 28 new signings and possibly adding over 3,400 or 3,400 more units across various Southeast Asia destinations. Yeah, so it's a huge positive for them. So this 3,400 is currently they have about 67,000 units today. Yep. RevPAR has exceeded pre-COVID levels. Wouldn't it be fair that hospitality REIT share price should have peaked? Yeah. So even though RevPAR has already exceeded pre-COVID levels, and it seems like RevPAR growth will slow down, but we haven't accounted for the fact that the interest rates will start to come down. So when after accounting for the fact that interest rates come down, we believe DP will continue to improve, and that will likely have another leg of room for growth for these hospitality REITs as well as the other REITs as well. So yeah, I wouldn't say that the share price of these REITs has already peaked, or other hospitality REITs in particular has peaked, because there is still room for growth from the lower interest rates. Yeah, and also with lower interest rates, cap rates will likely increase, and cap rates will likely compress. Sorry, with lower interest rates, cap rates will likely compress, and that will help to benefit the valuations for the assets as well. What is the estimated percentage DPU increase with rate cut of 1% for REITs? Yeah, so on average, we did some sensitivity analysis, and with a 1% or 100 basis points decrease in interest rates, that will have a positive impact, or about a 5% growth of DPU on DPU increase on average. And hi, do you have any recommendations for logistics and DC REITs? Yeah, we have some recommendations. We have reduced on Triple DC REIT, and we have a buy on Cromwell European REIT, which is also a logistics light industrial REIT. Yeah, but for the other mentioned Mint, Mapletree, Capital in China, yeah, we don't cover. That's why it's not on our list. Yeah. Oh, there's one in the chat. What's the outlook for Parkway Life REIT? Is it too late to commit? Yeah, Parkway Life REIT, they are now trading at about 3% yield. But there is a kicker once the AEI completes for the Singapore side. So yeah, we do not think Parkway Life is attractive because basically the yield is too low, and we have to wait for at least until 2026 before there will be a increment in NPI from the Singapore property side. So yeah, we do not think it is attractive, even though we don't cover. That is our view for now. Yeah, that is despite the fact that they have some solid Singaporean hospital assets. But basically, from a yield perspective, 3% yield, yeah, it doesn't, yeah, it's just not attractive in our opinion for REITs. Yeah, hand over time to Zane. Thanks.
Thanks, Darren. I'll move on to the EA portion. So I'll just share my screen right now. Yeah, so the first question is on Beijing clean energy. So looking at the chart, I think overall there's still some pullback going on for now. A bit sideways currently. It did a retest. Currently rebounding from this previous resistance at around 170, and doing a retest of this around 180 key support breakdown level. So I think I will expect some resistance over here for the time being. Price could just consolidate sideways for a while. With some support maybe coming around 175, 176 around there. Okay, then next question is AEM. Okay, for AEM, I think could be building this bearish flag pattern over here for now. You can see price slowly going upwards, but still quite a lot of resistance ahead, especially now when this 138 level, this swing high price met some resistance and just consolidating sideways. So yeah, some resistance over here for now. I will still expect some sideways movement. Support to come around 129, 130 level over here, which is this horizontal level, and this near the channel support as well. And then above 138, the next key resistance will be this horizontal level around 149, 150. And for the next question is on the three local banks. So first up is DBS. I think DBS is still very strong last week after some slight consolidation at a prior resistance of around $38. Then we saw a breakout of it this week. So I think it's still very strong. Definitely trading above I think it's the 5-day, still trading above the 5-day moving average. And then we see when the pullbacks come, is held along the 10-day moving average as well in red. So still signifies a very strong trend, and I think we're still likely to see some new highs ahead coming for DBS. Then next up for UOB, quite similar as well. Last week, it was consolidating over here, some resistance at 32.50, but subsequently broke out of it. So I think it's still holding along this support line over here. Currently hit some resistance at 33.30 perhaps, but I think looking at the overall trend, it's still very strong, quite similar to DBS, also holding along 5 and 10-day moving averages. And for OCBC, it's the same as well. Also did a bit of consolidation between $15.20 to $15.35, and we saw a break upwards. And so still very strong momentum, and still possible to see new higher highs ahead. Also trending well above the short-term 5 and 10-day moving averages. So in general, for the three local banks, we're still seeing very strong bullish momentum on the charts. Next one is some of the REITs. First up is Suntec REITs. Okay, for Suntec REIT, I think it's some slight pullback from a resistance. So previously, this 134 level was a resistance. Price moved above it, but it couldn't hold. I think some slight pullback going on now. You could see maybe a retest of this 127 resistance breakout, possibly turn support level. Then I just consolidate sideways for a while afterwards. The next one is on land lease. So for land lease, I think also quite similar. Price met some resistance at the 61 cents level. Currently some could not hold above it, so some slight pullback, but I will expect support to come in this at this 59 cents horizontal level. So also possibly some sideways consolidation afterwards. Then next one is Wilmar. So for Wilmar, I think generally it's still quite sideways, still finding resistance at this 320 swing high level, and then it's also this trendline resistance from this blue color trendline over here. So I will still expect some sideways consolidation for the time being. Yeah, unless it can break above this 320, then you could possibly see higher, it move higher to test some levels at 325 and then around 335 next. And next one is MIT. So for MIT, some slight pullback from resistance around 260 previously. Then currently, I think this level around 240 to 245 area should hold as a support, which was some consolidation area over here at the start of this month, the prior swing as well. And Mapletree, next one is Mapletree Logistics. Also finding some resistance at 146 over here. This swing high level, and possibly some pullback in the near term to retest prior resistance levels around 137, 138 over here. Then it just could move a bit sideways afterwards. Okay, then for CICT, I think CICT is possibly trading in this upwards channel over here. So some pullback from the channel resistance around 216 to 17 currently. I expect a bit further pullback towards 205, 206, where we should get some support over here with this price being a prior horizontal resistance as well. Okay, the next one is SIA. So for SIA's the trend is still strong over here. Currently retesting a prior horizontal breakdown previously around 660. So some slight consolidation over here for now. If you can break above the recent resistance around 665, then we could still see it's still possible to see the price move higher to test the next resistance around 670s. And then next one is on sets. Now for sets, I think price is currently kept in a bit of a range consolidation between around 350 to 373. So I think nothing too much for now, unless we see a break out upwards of this 373 resistance, and we could see a continuation of this bullish trend over here. Next resistance level will probably be around 383 next. So I think now I think it will be quite useful to share the S3 index chart as well. So to see where in general all the REITs are currently at in terms of the technicals. Yeah, so I think we are quite near some resistance over here. It's around 1,140 about there. The swing high form in December last year. So some slight pullback over here for now, which could be the reason why some of the REITs are doing a bit of slight pullback. I would think support should come in at this 1,080 to 1,100, this area over here, which was this recent resistance breakout. So then I think we should expect some rebound after this slight pullback over here. So hope that helps. Next question is on Singtel. Okay, for Singtel, I think it's still holding this strong trend over here. Price is, you can see, is still very strong, holding above the 5-day moving average. Haven't even tested 10-day yet. So yeah, over here I think we still could see a bit of a consolidation over here. Then you can break above the 340 resistance. Then I think we could see maybe 345 to 350 next. And for next one is China Aviation. Okay, for China Aviation, I think not much developments. Still quite sideways. Price is still holding the support around the 84 cents, 85 cents area. So with resistance at around 86.5 cents and above. So I think still quite sideways and not much developments for now. The next one is on Bank of China. So Bank of China, I think in terms of chart, it looks like a double bottom over here at 325. Price is still doing a rebound, clearing some resistances over here around 354, 385. There's some possible resistance, but I think it could still go higher to retest this key trend line resistance over here. So that could bring the price a bit higher towards 362, where it meets some it meets some the key resistance ahead. Okay, for Sembcorp, Sembcorp I think is also quite strong as well. Currently, it's hovering around the previous horizontal resistance. This is around 537. So over here, we could still see some sideways price action for the time being. If we can clear the recent high again, then around 547, then we could still see price moving higher. Next resistance level probably be at around 555, then followed by around 568. And then for Apple is also at this quite similar to Sembcorp. It's at this prior resistance around 660. So for now, maybe some sideways consolidation. If you can clear this recent high of 663, then we could possibly see the price of higher to test the next resistance at 678. Okay, then next question is on Franklin. So Franklin, I think some it broke out of this downwards resistance line for a time being. So some recovery in terms of price, but I need to face some resistance over here from previous breakdown, this support at 135s. I would expect price to trade slightly sideways, but continue to form higher lows along the way. So probably support will come from the recent resistance breakout level around 129, 130. The next question is on Silver Lake. Okay, Silver Lake, I think after the news, it's just been moving sideways. So I think from TA point of view, nothing much from now. I think we'll still be like this, just moving sideways. And for Q&M, I think it's still in this range consolidation. Not much developments for now as well. Resistance is still at 29 cents level, and support is coming in between 26.5 cents to 27 cents area. And then for Comfort they'll grow. Price continue to rally after clearing some resistance at 142, 145. Sideways consolidation over here for now. So it's between 146 to about 151. Next resistance is probably around 153. Around 153 to 155 area. Okay, then moving on to some of the US banks. First up is Bank of America. Bank of America, I think some recovery last week after the weakness 2 weeks ago. Price managed to recover back above this $40 level over here to retest this swing high. So maybe some consolidation over here. If you can hold above this key level at $39.80 to $40, then it could be bullish for price to move higher towards the next level of resistance at around 141.60 and above. Okay, then for Citigroup, also some price recovery above this breakdown level at $60 over here to retest the resistance over here at $63. So perhaps some consolidation also. Then if you can hold this recent level at $60 as support, then it could be bullish for price to move higher to the next resistance at 65.30 as the next resistance. Okay, then for Wells Fargo, possibly a double bottom over here at $50.40. But then price is recovering above the first level of resistance at $54 last week. Managed to hold above it. So testing the next level at $56, and next one is at around $57.40. So over here, as you approach this next resistance area, I think we could expect some consolidation ahead first. I think there's also quite a few near-term resistance ahead at 58, around 58.50 as well, also with this downwards resistance line. So near-term wise, I think I will expect some choppy kind of range consolidation going ahead. And then for JP Morgan, I think managed to hold this key trendline support over here in blue. Over here previously, when price bounced off the blue color, this trendline support managed to sustain the uptrend. So I think for now it could be something similar. I would expect a rebound towards this current resistance area between 213 to about 218 area for JP Morgan, as long as it continues to hold these recent lows at around 207, 208. Okay, for US Bank Corp, I think it could be in a bit of a consolidation at the moment. Price is still holding this upward support line over here. Then recently also broke over the resistance at around 45.60. So I think as long as it can hold above this recent breakout, we could go on to see price test this $47.30 resistance next, and maybe do a bit of a consolidation afterwards. The next one is a Bank of New York Mellon. I think for this, it's one of the strongest in the sector. It's trading above this main uptrend channel it was in. This is still very strong at all-time highs as well. So I think with that, some slight consolidation over here. If price can break above this resistance at $72, I think we're still likely to see new highs ahead. Okay, next question is on Aztec. Okay, so for Aztec, I think it's slowly moving upwards. This rebound is still intact. We're seeing last week we managed to break above this range consolidation resistance at 99 cents level. So still seeing higher highs and higher lows in this stretch. I think it's possible that price could go on to retest this $1.02 swing high level, which is key resistance previously with this high volume over here. Okay, then Manulife REIT TA. Okay, for Manulife REIT, I think there are some pullback as well from resistance at near 13.7 cents, which was this previous this near the opening price of this gap down candle on high volume previously. So yeah, some pullback for the time being. I expect price to find some support along, possibly near the 10-day average, as well as this horizontal level around the 11.8 cents area over here. For Jaffa, I think after the news it has just been consolidating sideways. I think so I think nothing too much. We're just likely to remain here. Golden Agri Resources. Yeah, Golden Agri Resources, I think still in this range over here, 28 cents as a resistance. Yeah, so I think we'll just remain sideways over here. The next recent upward will be around 29.5 cents and 31.5 cents. Okay, then next up is Meituan. Okay, for Meituan, I think some bullish momentum recently, price breaking above some resistance levels, 122 as well as 129. That currently hitting the next resistance area around close to 139. So I think some slight pullback or consolidation is likely. Next key resistance upwards is close to 148 to 150. So for now, we might see some slight pullback and do a bit of a sideways consolidation first. And then next one is on the Hang Seng Tech Index. Hang Seng Tech Index, overall, starting to rebound a bit, but we expect still some resistance ahead. So looking better recently, as if over here we're starting to see a higher high compared to this recent high at 3,800, around 3,600, breaking out this base over here. But we still expect some resistance ahead, this close to the 3,800 to 3,900 area over here. So maybe it can go a bit higher, but we expect some resistance afterwards. Okay, then for the HST, the Lion OCBC, Hang Seng Tech, yeah, quite similar as well. Price moving. Okay, price is breaking above this 59 cents range consolidation resistance as well as this downwards resistance line. But for now, I think still quite a lot of resistance ahead at 61 cents as well as this 63 cents level. So it could still move higher, but perhaps some consolidation afterwards. Okay, then next one is on Thai Bev. Okay, for Thai Bev, I think it's looking better. It's holding up. First, for now, we are seeing price hold above this 52 cents resistance over here, which was as a support. So it can hold this level. I think it's quite positive for price to potentially rebound. If you can break above the 54 cents resistance. Next key resistance area is around the 57 cents, then followed by the 59 cents mark. Okay, next one is on Genting Singapore. Genting Sing, yeah, some recovery recently, but I think with price action wise, it's likely to still remain a bit sideways. Some resistance is expected from this 86.5 cents area. Yeah, price is likely to do some sideways for now, but holding support probably around 83.5 cents, 84 cents area. So probably it would likely to do some sideways over here unless it can break above this 86.5 cents level. Then we could see price move higher to the next level at 88 cents to 89 cents. Okay, then next one is some of the Hong Kong counters. First up is Baidu. For Baidu, I think generally is likely to be still trading this range over here. Price is holding in a tight range over here now. If you break above this $86, I think it could move high in the near term to retest this resistance at 88 next. Then 88 to about $90 this area. Okay, then for JD, JD also currently is breaking above this resistance at 107. So testing this level at this resistance at 115, 116 area. So possibly could see a bit of resistance. Yeah. The next resistance level is around 121, 122. Okay, I'll answer two more questions since we are close to 1 p.m. For Alibaba, price is broke over the resistance at $84. Next one, next key resistance will be at $90 over here. So I will expect some resistance to come in the near term where price has consolidated for a while. Then after 90, the next key reason will be around 96.50. Then last one is on Ping An Insurance. So about Ping An Insurance, I think it's continuing this upwards trend over here. Price managed to break above this resistance at $36 for now. So I think we'll inch a bit higher to test this next level at close to $39. And this also is confirming the a downwards resistance line over here as well. So I think that's all for the TA as well as for today's webinar session. I'd like to thank everyone for attending today's webinar and for all the questions. Sorry, I'm unable to take all the TA questions if you have time, but feel free to post in our Poem 3 Telegram, Poem 3 community group or Telegram. Yeah, and hope to see you all in our other corporate insights webinar as well, and next week our weekly market call next week as well. So on behalf of my team, I thank everyone for attending. Thanks.